Welcome to the Deep Dive. I'm your host, and today we are tearing into a really fascinating stack of financial reporting.
Hey everyone, glad to be here. And yeah, we've got some incredibly interesting material today.
We really do. So our mission today for you, the listener, is to decode the June 2026 first quarter earnings release from PVH Corp.
Right, and for those who might not know the corporate name, PVH is the massive apparel conglomerate behind iconic brands like Calvin Klein and Tommy Hilfiger.
Exactly. And, while fashion might seem to just be about hemlines and seasonal colors and logos, this report reveals a really high-stakes corporate balancing act.
Oh, absolutely. The distance between a cool billboard in Times Square and actual sustainable profitability is just a massive, highly technical gulf.
Yeah, I mean, how does a global giant hit like $2 billion in quarterly revenue and completely beat earnings expectations while simultaneously navigating Middle East conflicts, shifting tariff laws, and a major internal restructuring?
Right, all while trying to convince you to go out and buy another denim jacket. It's wild.
It really is. Okay, let's unpack this. Because to understand how PVH hit that impressive $2.025 billion Q1 revenue, we first have to look at what they're actually putting on the shelves.
Yeah, and how they're selling it. The filing outlines a core strategy they're using right now called the PVH Plus plan.
The PVH Plus plan, right.
Exactly. And a major pillar of this plan is focusing on what they call full hero product categories.
Hero products. So, I mean, for Calvin Klein, that basically means leaning hard into denim and underwear, right?
Yeah, and for Tommy Hilfiger, it's sweaters and outerwear. They're ruthlessly focusing on those specific items.
But narrowing your focus that much in an industry that is notoriously fickle, I mean, that feels like a massive risk. Why intentionally ignore other apparel categories?
Well, because chasing microtrends really destroys your operational leverage.
Oh, interesting.
Yeah, the PVH Plus plan is all about scaling the impact of product innovation within proven high-volume categories. I mean, think about the supply chain efficiency here.
Right, if you're making a million different things, it gets complicated.
Exactly. If you produce 50 different styles of, niche garments, your manufacturing costs just skyrocket.
Yeah.
Your warehouse logistics become a nightmare.
And you inevitably end up with a ton of unsold inventory.
Right. But if you pour all your capital into perfecting the ultimate Tommy Hilfiger sweater, your hero product, you can manufacture it at massive scale.
Which drops your unit cost and drives higher margins. It's like a struggling restaurant that finally decides to stop offering a confusing 10-page menu and just doubles down on its famous signature dishes.
That is a great way to put it.
They know what the customer wants, and they're serving it directly to them. And you can see it in the numbers. Direct-to-consumer revenues, their DTC jumped 6% overall.
Yeah, or 3% in constant currency. And if you break that down, it's even more telling.
Right. Their owned and operated digital commerce spiked by 11%, and even their physical store revenue grew by 5%.
What's fascinating here is how this contrasts with their wholesale partners.
Yeah.
While DTC is booming, wholesale revenue was totally flat.
Wow.
Yeah, and actually down 6% on a constant currency basis.
Wait, I have to challenge the narrative there, though. Is that wholesale drop just because third-party department stores are struggling to get foot traffic? Or is PVH, deliberately starving their wholesale partners to keep the best stuff for themselves?
It's really a combination, but it's heavily driven by a strategic pivot from PVH.
Okay.
When you sell wholesale to a major department store, you lose control over your brand presentation.
Right. Your premium Calvin Klein jeans end up crumpled on some messy discount deal.
Exactly, which totally dilutes the brand equity. Plus, the department store is taking a massive cut of the profit.
So by driving the customer directly to their own websites fueled by these 360-degree spring marketing campaigns, they mention targeting power consumer segments, they keep the full margin.
Yeah, they successfully take direct control over their relationship with the consumer.
Okay, so the core strategy is working. But if DTC is booming, why did PVH have to lower its full-year revenue outlook to approximately flat?
Well, for that, we have to pull back and look at a global map.
Right, because the momentum is definitely not even everywhere.
Not at all. The world is really split for PVH right now. In the APAC region, Asia-Pacific revenue is booming. It's up 10%.
6% in constant currency, although the report does note a bit of a calendar quirk there, right?
Yeah, good catch.
Sure.
There was a 4% favorable timing impact because the Lunar New Year fell entirely within their first quarter of 2026.
Got it. And then you have the Americas, which saw a really slight 1% dip.
Right, and they mostly attribute that to a timing shift in wholesale shipments, moving from the first half of the year to the second half.
So the US and Asia are holding steady or growing. The real headwind, the anchor dragging down the global projection, is EMEA, so Europe, the Middle East, and Africa.
Yeah, EMEA was down 5% in constant currency.
Wait, so a 5% drop across an entire continental region is massive. And the source explicitly cites the prolonged effects from the conflict in the Middle East and its broader macroeconomic effects.
Yes, it highlights that as a major driver for softer consumer demand in EV.
And just to be clear for the listener, we aren't taking any political sides here. We are strictly looking at the business realities outlined in the PVH report. So it's not that consumers in EMEA suddenly stopped liking Calvin Klein, right?
Right.
It's that severe geopolitical tension creates a heavy macroeconomic atmosphere. It either tightens their wallets or simply suppresses the desire to go out and shop.
Exactly, and it really shows how interconnected global markets are. A localized conflict creates a massive ripple effect across an entire continental reporting region.
So how does that actually play out on the ground for a clothing company?
Well, geopolitical tension often disrupts crucial shipping lanes, which delays inventory and spikes freight costs. Plus, regional instability can trigger volatility in global energy markets.
Which means European consumers are suddenly facing higher domestic energy bills and broader inflation.
Right. So purchasing a premium Tommy Hilfiger jacket becomes one of the first things a family cuts from their budget. The psychological pullback in consumer confidence drastically alters inventory and sales projections.
Okay, so if EMEA is dropping 5% and dragging down the overall revenue projection, you would logically expect their profits to take a massive hit.
You would think so, yeah.
But they didn't. Their operating margin guidance is totally unchanged at 8.8%. How on earth did PVH pull a rabbit out of a hat with that massive hit in Europe?
Here's where it gets really interesting. It all comes down to tariffs.
Tariffs. Okay, lay it out for me.
So PVH has been facing a 15% blended tariff rate on goods coming into the U.S.
Wow, 15%. That's a huge tax on their profitability.
It is. It creates a massive $195 million gross impact to their EBIT. That's earnings before interest and taxes.
So to put that in perspective for shareholders, that's about $3.30 per share just wiped out by tariffs.
Exactly. But they are expecting approximately $100 million in refunds related to previously paid IEPA tariffs, and that's expected to hit in Q2.
Wait, IEPA, that's the International Emergency Economic Powers Act, right?
Yes, exactly.
So if I'm understanding this correctly, a massive bureaucratic refund check essentially acted as a financial parachute.
Basically, yes.
And that allowed them to maintain their 8.8% margin and absorb the shock of the Middle East conflict's impact on their European sales.
If we connect this to the bigger picture, this is exactly why their non-GAAP EPS was actually $2.01, which just absolutely crushed their guidance of $1.65 to $1.80.
That is wild. I mean, it really shows how vital it is for multinational corporations to have aggressive tax, legal, and tariff mitigation teams.
Oh, for sure. They are literally saving the bottom line. This massive refund, combined with internal tariff mitigation actions and lower product costs, partially from favorable foreign exchange, it completely offsets the financial damage from the EMEA slowdown.
But, you can't just run a business hoping for lucky tariff refunds every year. Eventually, you have to fix the underlying operations, right?
Absolutely. And PVH is actively rewiring its internal plumbing to ensure long-term profitability. This brings us to their operational discipline.
Right, because looking at the filing, their inventory was actually decreased by 5%, bringing it down to $1.51 billion.
Which is a fantastic sign. It means they aren't sitting on unsold clothes.
Right, because when inventory balloons, you end up having to run those desperate 50% off clearance sales, which just destroys the brand image.
Exactly. But maintaining that discipline takes work. They are currently in the middle of a massive restructuring initiative called the Growth Driver 5 Actions.
Growth Driver 5 sounds very corporate. What does that actually mean for them?
It's essentially about simplifying the operating model and centralizing processes.
Which usually means layoffs, right? And the report backs that up. They took a $7 million hit in severance and restructuring costs this quarter.
Yeah, and that follows $93 million in costs for similar restructuring back in 2025.
So what does this all mean? I mean, they are essentially renovating the house while they are still living in it, right?
That's a really good analogy, yeah.
They are trimming the fat with this Growth Driver 5 initiative, but they're also making a huge pivot with their intellectual property. The report mentions they are taking previously licensed women's product categories and bringing them in-house.
Yeah, to their wholesale business. Historically, they would rent out the brand name to licensees who would design and sell the women's apparel.
But now they are taking direct control of it.
Right, because this data and demand-driven operating model is what allows a company to actually survive the volatility we talked about earlier.
So you don't have some third party pumping out inferior product just to hit their own quotas and cheapening the Calvin Klein name.
Exactly. By controlling inventory and bringing licenses in-house, they retain brand value and avoid the trap of deep discounting.
It's all about control. And there were a couple of other interesting financial tidbits in there, too. They didn't buy back any stock in Q1, but they plan to repurchase $300 million for the year.
Yeah, solid vote of confidence.
And they are also selling a warehouse in Jonesville, North Carolina for a $25 million pre-tax gain in Q2, just cleaning up the balance sheet.
Exactly. Optimizing their physical footprint.
So to kind of recap this journey for you, the listener, we've seen how PVH is using hero products to really drive direct-to-consumer growth.
Right. Doubling down on what works.
They are weathering severe geopolitical storms in Europe while riding high in Asia. And they used a massive $100 million tariff refund to basically balance the books.
All while completely rewiring their internal operations and bringing their licensed products back under their own roof.
It's a lot of moving parts.
It is. And for you listening, this is really a masterclass in reading between the lines of a corporate earnings report.
Oh, definitely.
It proves that a company's success is rarely just about whether a product is, cool or not.
Right. The clothes are almost secondary at a certain level.
Exactly. It's about supply chain agility, geographical diversification, and navigating incredibly complex international trade laws.
Which is just crazy to think about when you're just buying a pair of jeans. But this raises an important question, doesn't it?
This raises an important question, yes. Because if global conglomerates like PVH are increasingly relying on their own DTC channels.
Right, their own websites, their own retail stores.
And bringing licensed products back in-house to survive macroeconomic shocks. What does the future hold for the traditional third-party department stores?
That is the big question. I mean, department stores and wholesale retailers used to be the absolute lifeblood of these fashion brands. You literally couldn't scale without them.
Right. So are we witnessing the slow extinction of the middleman in fashion?
It really feels like it. If PVH can use their data to sell their hero products directly to you and keep the entire profit margin, why would they ever go back to the old model?
It's definitely something to watch closely in the coming years.
Absolutely. Well, we want to thank you so much for joining us on this deep dive today.
Thanks for listening, everyone.
And as always, keep questioning the forces shaping the businesses around you. The real story is almost always buried in the margins. Catch you next time.